Hello everybody, welcome to another update on the stock screen. Today I'm going to talk about Trillion Energy because I'm an investor, so I need to do some due diligence on this. And I have to say this is one of the most complex, difficult stocks to analyze, so I'm just going to do it high level. So it has a cup and handle, as you can see here, and is about to break out, and I think it should break out. This is a Turkish natural gas play and should follow the European gas price. So we are looking at this. Now the Turkish gas price is now around here, 100. So it's not quite the same as the European gas price. So it's a bit lower than the European one. But normally it should converge together with it. So this is actually a European gas play. Now, what is the current Turkish gas price? We see here, 25 August, 18,000 is the current gas price in lira, in Turkish lira per cubic meter. And cubic meter is the same as 35 feet. So this in lira is $1,000. So divide it by 35 gives us $30 per MCF. So this is MCF. So $30, okay? Now let's take a look at the company's variables. First, we have a market cap of 163 fully diluted. I take the fully diluted share, so 163 million. 10 million debt, a very high price to book value. This is just a startup. So a lot can go wrong. If they drill it and there's no oil in it, then it can go to zero, okay? A very risky play. But if they find what they already drilled for, then we have cash flow. But there is risk. Cash, they are cashed up. They are fully funded to build it. And they are going to build it very soon, next month. Equity is low, of course, but it's going to get higher. Okay, so zero earnings right now. EBITDA I have calculated. Now they have 20 billion CF cubic feet of gas, P&P, and exploration they have another 20, so about 40. And if you add other reserves to it, then it's 60. So this gives us a mine life of about 2 years. But of course, this is not a gold mine. So if they drill it, then the production will go down over time. So mine life is actually around 7, but the production keeps going down. So that's the first difficult part of this already. Production is not constant. Now we have price to EBITDA of around 1, but yeah, that's assuming constant EBITDA. Okay. AISC, this is important. It's very cheap to operate this. So we have a $30 MCF price of natural gas, and the cost is only 1, below 1, probably half. So this is a high margin project, high margin. So this is the amount of production that they get initially, but it will go down over time, of course. So they have 2 phases. This is the first phase coming on this year until next year. And then they have the second phase, which will come online in 2024. So both phases, when you add these together, that will give us an MPV that we will talk about later, mine life is normally 2, but it goes down, then it's 7. They have 49% interest in the project. They have a partner, but all of these numbers are 100%. Then we have a royalty that we need to subtract from the revenue. We already know OPEX is around 1. Tax rate is 23% in Turkey. There was initial capital, but that's already funded. Total capex is 100, so there is still some capex that we need to deduct, and there's a recovery factor of 80% that we need to take into account. So I inputted everything in this. Let's go over the formula. So this is B17. B17 is the production per day, MCF per day. So we do times 365 for a year. So that's production times price, and the price is E4, that's the 30. Price is 30, but we need to multiply it with the royalty, 1 minus the royalty percentage. So we deduct this, and we also do a recovery factor of 80%. So that's also added here. And then we have minus B16. That's the AIC of 1. So that's a small number here. It's insignificant. And then we have our production times price minus cost. Then I deduct from this another capex, and this is divided by 2 because we have 2-year mine life. So I did it divided by 2. So the capex is deducted, and then times 2 because it's only 2-year mine life. That's the multiple. So no 5 multiple anymore, only 2 multiple in millions. And then the last one is the tax rate. So we do it times the 1 minus the tax rate of 23. And so this gives us the actual value that we will get from this. And this is for the first phase. Okay. First phase gives us a value of around 230 million. So there's a tiny bit of upside just for next year, maybe 50% upside maximum. But then we have the second phase that comes online. So that's F4 plus the whole bunch again, but then with this production. So it's basically the same formula, but plus F4. And this will give us a value of about 500 million. So in 2024, this is going to be a triple, quadruple, okay? A quadruple at current prices. I think that is a good buy. I think these prices will stay elevated at 30. Could even go higher, maybe 40. And then we will see 4-fold, 5-fold, maybe a 5-fold in 2 years. Okay, that's the expectation, because energy prices are going to keep on rising in Europe. Now, let's take a look at how this production actually occurs and the NPV as well. So this is how the production will come to pass. We are going to drill some wells and the production will increase. Then this is for phase 1. And then they will do the second phase for another 8 to 2 wells, and we have a peak of around 7 million EBITDA per month here. Then it will start declining until 0. Okay, so based on this, I tried to calculate the average EBITDA, and this is at $9 MCF. We are currently at $30. So per month, I calculated that this is around 3. Okay, if we take the whole curve, this is around 3 per month. So per year, it's times 12 is 36. And over 7 years, then it's about 250 million. So the EBITDA is 250 million over the entire 7 years, with most coming in, of course, in the beginning 2 years. So that's also around the NPV that we get here. The NPV that they give is 170 before tax. And I think after tax will be around 136 for 10% NPV, internal rate, discount rate. Okay, so keep these numbers in mind, 250, 170, so it's around 200 million. Now, if we go from 9 to 30, you can do an easy calculation by dividing by 9 and times 30. That will give us 570. It will be a bit more because there is some margin here. The net back is 6 compared to 9. So there's a bit of cost here. So this will be probably higher than this simple calculation. Let's say 800 million. I'm just guessing. So 800 million, then this number here is higher than this one. So let's say 1 billion in total EBITDA at current prices. 1 billion. And over 7 years, that's, let's say, 150 billion per year. So times 5, 6 will give us the 500 to 600 million here in valuation. So these are the order of the numbers. Just to give you an idea that you will probably get to this 500 million in a few years. And we're currently at market cap of only 160 million. So there is upside, double, triple in upsides over the following years. So it's not a 50-fold or 10-fold. No, it's probably just a maximum of 5-fold at these prices. So we need to keep these prices in mind. Let's see where they go. There are people who say that this price can go to 90, but that's a bit too high, I think. I don't think that the Turkish price will go to this 90 level. But if it's worth to go to 90, then yeah, this can be a 2 billion stock. That's 10-fold, but that will probably not occur. So just use these conservative estimates and you will still get a triple in a few years. I think it's a good bet. Okay, so that's why I diversified in this company. Yeah, the financials are just not that important. It's just 2 million, 8 million, but we need to wait for the earnings to come in. Let's see if they can do it. We will know by the end of the year if the earnings come in. because then we would be somewhere here. Then we would have already the first peak, and by next year we will have the second peak. Okay, so earnings will come in very fast, and they just need to execute. And I'll see you in the next video. Bye.